Welcome back to the Everything Property Podcast. I have with me today, joining us back on the Everything Property Podcast, is Scott O'Neill from Rethink Investing. Now, if there's anyone that's qualified to talk about it, it's going to be Scott. As you've probably heard, skip back a few weeks, we interviewed Scott and we talked to him about a commercial buyers agency. Now we're sort of breaking down commercial property, the ins and outs of it. So we thought we'd bring him back to the show. Scott, welcome.
Good to be here. Thank you.
Good to be back. Thanks for coming back on. Look, let's jump straight into it and dive in. I think, and when you joined us last time, one of the things that you spoke about and we touched on previously was there's a lot of stereotypes about commercial investing, and that's why it isn't as popular, and that's what the media sells, and that's what a lot of people in the resi space use as leverage to get you to buy resi. Opening the mic up for you on your side of things in terms of commercial to shift the needle back your way. But a few couple things comes to mind is with commercial property, common myths is vacancies and vacancy rates. You buy commercial property, vacancies are a lot higher and you're going to have to wear that sort of cost. What would you say to, people with that sort of mindset and opinion?
Well, so they can be right.
Yep.
But if you I guess my experience with commercial property is very different from the myths, and that's why we wrote the book and all that kind of stuff at the start, because if you buy a good quality commercial property, there's a very high likelihood that you'll never get vacancy. Think about a good quality fast food place, your local doctor, your local dentist, they're probably the same place they've been since you were a kid, and obviously there's going to be other examples where there's high turnover. So there's a great variation between good quality commercial, that's the stuff you want, and then there's the more riskier stuff, and like in small regional towns that get bypassed, they're the disaster stories out there. But you can't generalize that because, and that's what the media will portray, those kind of little bad negative results. One thing I always hear is, there's all these for lease signs, in a complex. One of the reasons, a lot of people don't know this, there might be like 12 units in that complex, industrial units.
Yep.
I'll use an example down where I grew up in Tarrant Point, like it's one of the tightest rental markets out there. But there was this one complex I went into and there was 6 for lease signs. We went in there and there was no vacancies. The reason there was 6 was there was 2 for leases.
Yep.
And there was multiple listings. So, basically 3 agents had 3 signs on each one, and then they filled it and they didn't take it down because why would they? It's a feeder for tenants. Like it's a lead collector. So
interesting.
A lot of these for lease signs, they're redundant and old. And I know there's some markets where you can go online and Google it, and about 70% of the ads are old listings, and they just haven't been taken down.
Really?
So I'm not sure if it happens in residential. I don't think it does.
Nah.
But there's just no incentive to take them down because it is a collector for leads. And don't get me wrong, there's 100% going to be many cases where there's long vacancies. But you got to, when you really do your research, you can understand why and just avoid those types of assets and target the ones that tenants want.
Okay, so they're leaving those ads up and they're sort of like, oh, look, no, that's just lease, but we do have something down the road, something like that.
Yeah, but if you go somewhere like, an old highway where there's retail shops.
Parramatta Road,
then, there's genuine vacancies there because from a business point of view, what solution does that offer the tenant? Like it's, a customer, not many, because you're driving 70, 80 Ks an hour. Mm-hmm. You can't stop just quickly to duck into that store. There's no convenience to it. The car parks are around a back street somewhere and it takes you 5 minutes to even find a spot. So you're not going to go to that store. So they're the ones that are struggling. But the neighbourhood shopping centres where, because we buy a lot of these with our clients, they're fantastic because they've got the IGA, the medical centre, might have a pizza place in there or something like that. And then, your dentist, they're going as strong as ever. They got through COVID great. And, that's an example of retail that works. And retail that doesn't work, CBD office space. There's not enough people in here. There's a lot of businesses struggling. Obviously coming in here today, you can see plenty of good-looking properties for lease. So you just got to not generalise this space because it's like saying all residential's the same. But, is student accommodation the same as a mining town granny flat? It's completely different. So
well, while we're on that, before we jump into sort of the second stereotype. Let's break down just the different types of commercial office space. Also mentioned in the book, covered over a couple of chapters, but just for each, office space, retail, that kind of stuff, just a little bit, 3 or 4 main types and what they are and vacancy risks and what you either like or don't like about them.
Yeah, so the high-level summary is you've got 3 major asset classes and subsectors. So office, retail, industrial. They're the 3 biggest ones in the country. And then you've got specialty, which can include things like medical, pubs, car washes, childcares, all that type of stuff, fuel stations. There's a whole bunch in that category, but they're specialist assets. So they're kind of one purpose type and that comes with risk. But office is the one everyone's talking about right now. When you see on the news, it's always reported about offices tanking in Australia. And it's changed. People are working from home more. The flexible work arrangements seem to stay. I know with our business, like we're mostly, 2-3 days a week in the office now, but it was 5 before COVID. And and that's what a lot of big businesses are adopting as well. And it makes sense to a lot of businesses, and that's causing a crisis situation in the office market. And the problem with office as well, without getting too technical, there is big incentives in leases. What an incentive is, it's like giving a tenant a free week, here's a week rent free because we want you. But they're having to do 40% of the entire lease free.
40%?
It's like an incentive. And the way they do it to sort of pump up the valuation. So it's a way of lifting the face rent, which it's like funny accounting, That's not in the industrial space or even retail. So it was already in a bit of a weak position. Vacancy rates are in the mid-teens at the moment. Like Perth is up near high teens. Yep. That means almost 1 in 5 offices are vacant. It's a significant issue. And what will happen in this space, 2 things will either happen. One, they're going to boost immigration enough to just fill everything, which, seems like they're going that way at the moment.
Yeah, over 400,000 coming over in the last 12 months. Yeah, that's all there.
Yeah. So, and look, as long as businesses have the, seats ready, eventually that strategy will fill a lot of this vacancy. But a lot of that strength's going elsewhere too. It's not going into the office market. But I predict that the values will fall, and they have. They've already fallen at least 20% since COVID. They're going to fall into the same square metre rates as residential, and then they'll eventually have to refurb these towers into residential, and a lot of them aren't suitable for that, as you know from your background. So there's going to be some redundant buildings in the city that will have to get knocked over.
Wow.
And that's all due to no growth in the rents and too many vacancies. So that's a bad space, but offices can be really good in suburban areas, like your local accountant, your local lawyer, might be a freehold property with car parks, so not all office is dead. But yeah, in general, that's the weakest sector. The one that's sort of on fire at the moment is industrial. Yep. The history of industrial is interesting because for the last 100 years, it was like the ugly duckling. No one really wanted it. It was kind of like viewed as a third-rate asset class because it's dealing with manufacturing and just dirty products that a lot of people couldn't understand. But now with the whole Amazon type e-commerce boom, you just need storage. So that last mile logistics type model is incredibly strong at the moment. There's and storage can be anything from storing cold food. So you got some warehouses are all basically just big fridges, and they get it to the customer through cafes. Just cubic meters inside is important. So we're seeing rents grow at the rate of about 20% per annum for the last 2 years. So rents have jumped about 40%.
Is that if your is that between rental agreements, right? Because if you've signed someone up for 3 years, you've only got the CPI increase or whatever you agree to. So that's once you come off that 3 years, then you're only say if I own something, then I'm able to bump it up by about 20%.
Correct. So it's a really good value add strategy that we're doing with our clients. So you buy something and it's 20% under rented. Remember, the value is dictated off the rent. And if you increase the rent by 20%, your valuation goes up 20%, assuming you haven't overpaid at the start. So easy money sometimes. Now, obviously, there's an ugly negotiation in there. And what we do is we'll go with a spreadsheet to the tenant and say, look, here's all your neighbours. they're all paying 160 a square metre and you're paying 120. You know, what are you going to do? And they'll kick and scream and threaten to leave, but where are they going to go? There's no 120s out there to go. So it's I think one thing I do like about commercial versus residential is, I don't know, there's always a bit of an ethical issue when you raise rents. You know, you come across as the greedy landlord. And,
the media loves jumping on that one.
Yeah, but who cares if you're doing it to an ASX listed company? You know, good luck to them.
Yeah,
you know,
they can wear that.
Yeah, exactly. So obviously there's, the local fish and chips, store. Like there's variations to that argument, but it's a lot more comfortable and a lot more number driven. And it's a way of creating equity without lifting a shovel. So you can get development-like returns. And a lot of my clients are developers who've come into this space because you're doing it with a lot less risk. It's basically creating value adds through leases. And that's happening the most in the industrial space because vacancy rates are, around the 1%.
Wow.
Nationwide. One thing that's really contributing to a good long-term picture for industrial and other asset classes is build costs have gone up massively since COVID, and they're not coming down yet either. So remember, one way of hurting a commercial market is creating too much supply. That means there's more choice for tenants, owner-occupiers. Right now, the supply is not there because builders can't make margins because their interest is too high. Build costs have gone too much up. Even getting labour is hard these days. Like it's basically very hard to develop, on a small scale well, and that actually helps existing commercial owners because you've got less stock to compete with. So rents are just going up and up and up, and until there's a great, massive influx of developments, we can't see that. There's no real sort of light at the end of the tunnel for the tenants yet. But different size properties have different issues as well. So there's more smaller stuff versus bigger stuff, and that'll change depending on the economy.
Okay, so we've covered office space, we've covered industrial. What's the third and final?
So retail is the other one.
Yep.
This is one of my personal favourite ones. Like it's, I personally own a number of these like little neighbourhood shopping centres, and they're great because you've got your supermarket recession-proof, you've got your medical centre recession-proof, and then you might have a couple of more specky tenants that actually pay very high square metre rates. So you make your money on your, those smaller tenancies, and then your anchors kind of keep the thing running forever.
Yep. Keep the loans paid.
So it's a good play. I like neighbourhood shopping centres and that kind of stuff too because the zoning's quite rare. So you might buy it in the middle of a big housing complex, and you would look at DA maps all the time, like the residential green zonings everywhere, and there's a little square of commercial there. Owning that little square is it's almost a way of playing the scarcity game long term. You own a scarce product, so in 20 years' time, it's probably going to be worth more, and all the tenants will be different there, but you still own that scarce bit of land, and that's one way of locking growth in.
That's a valid point because it's a lot of time, a lot of money for a planning proposal, and to try to convince council that they need to change, especially in the housing shortage, more of that green space or that R2, R3 zoning into mixed use or commercial. So very valid point. Okay, look, I feel like I've got a bit of an understanding of each of the different sectors and where they're at. Another sort of big stereotype is capital growth. You touched on it a little bit there, but run the audience through how capital growth works in commercial property, because it's a little bit different to compared to resi.
Yeah, good question, and it's quite complex, and it's something I'm still finding new things out every day because a lot of the growth, high level, it's off the rent. This is what the most simplistic way of summarize it is, as the rent grows, the capital value grows with it. So if your rent grows 15%, then your asset will instantly grow by 15%. But then there's other layers to it, like cap rates. So the cap rate is, long story, is capitalization rate. So if you've got a cap rate of 6% and the rent is 60,000, you divide it by 0.06 and you get $1 million. So the value is dictated by the cap rate. So if the cap rate goes to 5%, all of a sudden your value will increase by 20% because 6% divided by 5%, there's a 20% variance.
Yep.
So it's a little bit hard to explain without showing people a spreadsheet.
I'll do a summary post on the Everything Property Instagram, but definitely.
Yeah, but if you understand cap rates, you can, it's like it's like leveraging value very quickly. So one value add is you might buy a shopping centre with a whole bunch of dodgy tenants in it, improve the tenancy mix because you've bought it at a higher capitalisation rate, because the higher the rate, the more implied risk.
Yep.
So if you buy something that looks risky and turn it into like something that is less risky, like get a bunch of national tenants on longer leases, the cap rate will shrink because people will cop a lower yield on it because it makes sense to them, it's lower risk.
Yep.
And you can actually get more money even if the rent's the same for the asset value. So that's another way of growth. Interest rates going up and down will influence that because people need a higher return as the higher interest rates go up. So, you know, one thing I'm predicting or hoping in, you know, over the next 2 years, there'll be some point the rates will come down.
Yep.
Everyone that's buying at these good cap rates right now will see a direct benefit to their portfolio value once that rate drops.
Yep.
So that's another way. And
because obviously interest rate drops means people have more access to more money. They go, oh, now it's time to jump into the commercial market. There's only, you know, $1 trillion worth Australia-wide, increases demand.
And we saw it in like 2011 and 22, like 2021 and 22, like people were going like, they were losing their hat to buy a property. Like they were buying childcares at 2 or 3% net returns. And it's because money was cheap. They had the money. Like I'm either just going to plonk it into the bank accounts or buy some bank shares or bonds, or own a nice freehold asset that I can be familiar with. And they made that choice almost too much, I felt. And that's softened now, but it'll come back once rates drop. Like the same characters will start going, overboard to buy anything they can. Pretty similar, or I think similar to resi space, is that people always say they're waiting for interest rates to drop and to make the purchase. But I'm like, when interest rates are high, it's actually the best time to buy. When it's dropped, you're going to be following the rest of Australia to jump in and into the market. So very true.
Interesting. Okay, well, talk to me then about getting into the market, because there's some examples in the book. I hear you float a few figures. There's a particular example where you say that for clients in particular, you're purchasing as low as 600K on 80-20% LVRs. Are you still able to do that? Or let's sort of talk about deposits needed, 35% cover cost, that kind of thing, in terms of getting a good quality commercial asset.
Yeah. So since the book, we've actually been getting more affordable assets because like interest rates have gone up since the book was written about 6 months ago. And so about 500K is sort of where we're getting some deals pop up. So that's entry. And the general purchase is a warehouse, like a small, couple of 100 square meter warehouse. And it'll be in the capital cities, like great investments, to be honest, because they've got tenants waiting. Believe it or not, they're worth more vacant too, because the owner occupiers are desperate for them too. Because there's a lot of people that rather own it than buy than become a tenant. So it's not like you're relying on the rent to uphold its valuation. Like they're actually valuable as vacant properties too, and that's in the entry level space. So you need I always say about 150K is a good spot to start, which is more than enough to buy a decent property in a capital city. You just got to wait and be picky. You can't expect to get a deal in the next 3 weeks when you're competing against several thousand other people in the market. But they're out there, and so it's not as out of reach as you think.
What's after costs? What's something like a 500 or 600 grand warehouse putting back in my pocket after it's paying for an interest only mortgage?
Well, it depends on your lending ratio, but you're probably around the 10 grand positive interest rates right now. That I'm still seeing them in the low sixes for commercial, so it's quite similar to resi at the moment. So
disgusting.
Yeah, and I was paying as little as 1.9% a few years ago. That was a free ride, but I actually hope it doesn't go back to that.
Really?
Because it would be a frenzy.
Yeah, okay.
And everyone's just going to, asset values will get so high.
Oh, what a shame, Scott.
They'll crash, though. There'll be something that sets it off, because no one can really leverage as hard as they were. I don't know. Yeah. I saw crazy purchase prices, like things doubling in a year, 2 years.
Really?
Yeah, in the commercial space. They were growing a lot faster than residential. Even some big ticket stories, like, guys buying like $100 million warehouse sites in Sydney and then selling it for 300 4 years later. Like it was exceptional returns. And, it's great if you're collecting that, but it's going to end.
Okay, so entry level, you're thinking about 120, 150, getting you into about a $500,000 commercial property. The more I pay, obviously the more options I get into. Is there anything, if that's entry level, but ideal world, what sort of that's entry level? What sort of the main? You guys are selling at about $2 million. You guys are buying, assets around $2 million for your clients on average.
Yeah, so Rethink Investing's like last 6 months, it's about 2 mil average purchase price. So there's obviously going to be some 10 mil buyers in there and then a bunch of these smaller ones, but average is about 2.
Okay. One thing for resi property, in terms of data, I know you guys, and we've spoken about it before, you guys have reviewed a lot of the data in terms of capital growth, rents and stuff like that. But in terms of data points for selecting a commercial property, resi, it's a little bit easier. I look at the supply and demand. I can look at population growth. I can look at, rent, who wants to get in that area, government infrastructure and that kind of stuff. But what are some of the data points that you're looking at for commercial? Because it's completely different, right?
Yeah. So the first thing I look at whenever I buy a property is the rent. So, let's say you're buying a warehouse in, I don't know, wherever it is. That suburb, you want to find out what the other similar sized properties are renting for.
Yeah.
And it's really easy, I think. Like you might have to go to the property managers to get this data. You might have to literally just work it out yourself through previous listings of leasing ads, and then you've got to find like the legal floor area. And legal floor area, that's a whole nother topic as well, because things like mezzanines and stuff are often mostly illegal, but then they include it on the floor space, so that could pump up the value. So so you got to be a bit careful with that. But basically make sure the rent's at market, and when you're good at that, you can find value adds too. Like if you're finding a retail space and the average rent is $400 a square meter for that area, and you can see all the others are paying $500, there's 20% upside potentially for you. So that can be a really big opportunity too.
So rent and leasing square meters, what's it renting and returning for? But how do I know that? Are you any sort of supply and demand data, infrastructure projects, that kind of stuff? Are we diving into any of that? Or
before you do that, rent's part one. Part two is the cap rate. So you need to find out what you should be paying for that rent. So if all the childcares in that area are selling at 5% cap rates, you need to basically offer around 5% on the yield, or 5.25 or 6%. You don't want to be paying 4% if they're all, getting better yields than you, because your valuation will come in short. So verifying rent is step one. Step two, understanding how much you should pay for the offer for that rent. So, and then you can offer on the property subject to due diligence. And then you go into all that other stuff. So you look into upcoming DAs, you look into tenant demand. I call the tenants, literally ask them how their business is. Is the roof leaking? Because it probably won't show up in the building report unless it's raining that day. All that basic stuff. We've got a 100-point checklist that we go through on every property, and depending on the asset class, there's a different checklist as well. So it's complicated, but I actually think it's lower risk because there's so much you can check. There's a lot more legwork you've got to do, but I feel like once you've done that, you really understand exactly the valuation to the decimal point. Residential, it's the neighbour sold for that. The kitchen's better in that thing. The bricks are 10 years newer on this thing. It's a little bit more wishy-washy. And this is just facts and numbers, and that's why I can put offers on properties with complete confidence, assuming the tenant's paying on time, which we check. And you don't overpay as a result.
And is there anything on incoming supply? You said in DAs and stuff like that. How are you measuring demand of who wants? Is that purely on the ground and leasing managers and stuff like that? It's a little bit harder with, obviously, resi. I can see how it's calculated, but commercial, I'm just interested how that's measured. Yeah.
So with every asset class, there's different measurements. So I'll use the childcare one because that's probably one of the more complicated ones. So we'll go into the demographics of the area. So let's say there's 9 childcares and they've got 100 spaces for kids.
Yep.
So that means there's 900 seats for kids. And we then look at maybe there's 4,000 kids under the age of 4 in that suburb. But 25% of them, we've got to work out, is it 50% of them have stay-at-home parents? So only then half of that demographic will need the childcare sector. So we might work out, in that example, there's 2,000 kids that need spaces. So all of a sudden there's an undersupply of that market. We then call up every single childcare and work out the exact occupancy rate, because they should tell you if there's a waiting list. So
are you calling them up as Scott from Rethink, or are you calling them Scott with his daughter that needs a place in childcare?
One of the guys on my team will be a secret shopper, basically. Yeah.
Yeah, very good.
But if you're dropping 4 or 5 mil on an asset, this is what you got to do. You don't just go off gut. You go off, all right, well, they're all running at 80% occupancy. There's and then you go call the council, and you can look into their online programs, what DAs have been lodged. So you might have a 2-year window of future childcares coming up, and there might be 2 more. They might have 60 places each, 120 extra. It's still a shortage. So we know that business is viable. So we're almost we could run the childcare at least economically. We don't want to do all the stuff with the management side of things, but we understand the viability of the business, and it's going to be a little bit harder with things like warehouses, but that's where you go more on the vacancy rates. And let-up period is the easiest way to verify quality of the market, so you can see when ads are first listed and first filled. Yep. So that RP data will show you that.
RP data on the commercial side will?
Yeah, they'll just show when it was listed. Remember, most is not put on, but they still do a lot of ads on that. And you can see it's been listed, 3 months ago, and it was filled. And then you see another one, it was a 4-month vacancy, another one, 1-month vacancy. And you just average them up and go, all right, well, we're comfortable that we'll have to deal with a 3-month vacancy at the end of this lease, which is in 5 years' time, based on the current market conditions. And you just start getting comfort around it. And the other thing is, if you talk to the tenant, you might realise they're in deep into this property. They've just spent money on a fit out. They're happy. So you probably might get them for 10 years plus anyway, based on the feedback you're getting. Yeah,
so that's cool, because that leads into one of my questions in the book, that you said the normal resi tenure for someone that's renting a resi place is about 17 months.
Yep.
Now, for commercial, it's 10 years, but then you're saying that the leases are only typically 2 to 5 years.
Yep.
And then they're moving on and stuff like that. So talk to me a little bit about how the leasing structure works, incentives, that kind of stuff. Maybe if it's around, I don't really want to touch too much on office space, but in industrial and stuff, I'm interested in it. So are you able to sort of touch on that a little bit more?
Yep. So as you said, you're probably working with 2, 3, 4, 5-year leases in general. Every now and then you'll get a 10 in industrial, but you generally offer them a month free rent for every year they sign. So if they've got a 3-year lease, here's 3 free months of rent. 5-year, here's 5. And you're going to get that off in a cash bond anyway, so you kind of will collect the money as a bond, then so it kind of cancels itself out from a cash bond. So how
does if I'm the commercial owner and I arrange that with my tenant, is that at the start of the lease, at the end, or does it matter when? I need to then have that 3 months of cash flow, right?
Yeah, So, but you can negotiate a 3-month bond, and remember, with commercial, there's no tenancy tribunal or bond. You don't lodge the bond with anyone. You keep the bond.
Okay, but then you still need to give it back to them if they move out.
Correct.
Right?
Yeah.
Okay, so but by then you've made your positive cash flow.
But then you might go, I've got a bank guarantee instead. There's different forms of bond negotiations.
Interesting.
You've then got to negotiate director guarantees or personal guarantees on the lease. You're not going to get that with Woolworths though. So big tenants, you get nothing. You just get the security of a corporation, because if they bail out, then it's going to look bad from a PR point of view anyway. So, but look, remember, a lease is an IOU for rent. If they don't pay, it's a litigation process to chase the rent. None of this bond stuff that favours the tenants almost, blindly. So if a tenant stops paying you, it's a pretty big deal in commercial, because you'll put a caveat on their personal assets if there's a personal guarantee. Yeah. The lawyers won't go. They'll keep chasing, So what will happen generally, if a tenant needs to leave early, they go with something called a sublease. So that means they're responsible for effectively finding someone else responsible for a portion of the property or the whole property. And then, that new tenant goes, yeah, great, I'll jump in. The tenant needs to pay for all the legal costs, all the marketing, everything. It's got to be done on their watch.
Does that tenant that they're subleased to, do they get told what the actual rent is? Like, for example, if I'm moving out and I go, all right, I've found this guy, he'll pay 50% of the rent, we'll pay 50% because we're moving out. Does he know that it's the 100% and he sort of sees that figure that he will then need to bump up to?
There's different versions of that.
Okay.
I know what you're asking, because there is some times where you've got a very smart tenant who, and they're often accountants, and they might have 1,000 square meters of office, but then they give 200 square meters to a mortgage broker and 200 square meters to a lawyer, all these kind of potential referrers, but they're charging them a higher square meter rate. Yeah. So the way they get their rent basically supplemented by these guys, and they might be paying 40% higher per square meter. So all of a sudden they're not paying much rent, and then they get. So there's lots of angles, but generally in terms of the vacant, they'll just show the whole lease. They just want out of that lease. The first lease I ever signed, for Rethink was. It was an office one in Bondi Junction, and it was a medical company, and they were getting shipped back overseas, but there was 2.5 years left on the lease. Yeah. So I just resumed responsibility for that lease. Yeah. I got all their furniture chucked in as the deal, and at the end of that lease, I then renegotiated my own. So I guess the good thing out of that is tenants don't just vanish, because if they did, we'd be chasing them, or the Westfield was the landlord in that case. Westfield would have just chucked lawyers at them and chased them all the way back to the US for that money. Mm-hmm. So you can't run from an IOU in this space. Okay,
so you potentially have the bond, but if they don't have the sublease clause or something in the lease, is there anything else that says they need to pay, like when you quit in a phone plan, you have to pay X amount of the lease that's left or anything like that?
Well, it's all you can negotiate anything you want. This is a landlord versus a tenant. Again, it's generally a lease that's been created by an individual lawyer. Like, yes, there's standard leases and there's Retail Act leases and stuff like that. But there's other leases that have been created for the exact situation. So they can have anything you want in it at that day. But when that kind of circumstance comes up, like I've got a couple of clients that have bought properties and they want to develop on it. So if the tenant comes early to say, I want out, they're laughing because there's no demolition clauses in these leases. So there are cases where landlords want you to go. Using the industrial space example again, is a lot of tenants are paying way under. So if someone, like an agent came to me the other day and he said, I've got a 20-year lease. It's got 3% increases. And I said, that sounds great, but that's garbage, because it was fixed at 3% increase for 20 years. So why would you want that when rents are going up 20% or 10%? Like, we're going to fall so far behind the market, it's going to be embarrassing.
Oh, interesting.
Yeah. The returns on that would be disastrous. And if you bought that and the tenant came early, you'd go, yeah, let's go, because you could pump your rents up, whatever number it is. Okay. And all of a sudden your equity will grow, and there's another tenant 5 months away, 6 months away anyway. Yeah. It's, we're talking about, the overall picture here. Like, the lease security would drop, but your asset might grow considerably in value.
Okay, so it kind of works out better as the owner to have a 2 to 5 year lease, because you can get them out or renegotiate. Whereas if you're signing into a 10-year lease and you're fixed with, here I am thinking the CPI increase is good, but if you're fixing into like a 10-year lease, then it's like, it could be severely under market rent, which is great news for the tenant.
If the rent's going up. Otherwise, if you bought an office space in Perth where rents are shitting themselves at the moment, and you had a 20-year lease on 3%, that's the holy grail there. But the tenant will probably go broke. That's the problem. So you'll be chasing them for their assets. And, long leases I think they are overrated to a degree. Like, the more experienced investors generally just want a good asset with that they got flexibility. But novice investors want a big long lease because it makes them feel cozy at night.
Yeah, okay. That's something I think I've just learned. I was just writing down some notes too. But okay, talk to me about I think to maybe finish off financing. So the LVRs and the interest rates, but also with Resi, how it's obviously calculated is the bank says if it's an investment, how much money do you have coming in? Can it cover costs? Blah, blah, blah. Most of the time with resi, it might equal out, or with interest rates, it's not going to equal out. But with commercial, there's obviously a lot of this excess cash flow. So in my head, it's almost as if the lending would almost be easier because you've got a tenant lined up to pay X amount, like that 5-6% yield. That's net, not gross. Is that the case?
So say that again. You've got...
So my thing, when I'm thinking about resi loans, is that the bank's calculating what the tenant will give, and they calculate that and they say, okay, well, it's not too good, it's not covering cost.
Yep.
But in commercial space, it is covering costs plus more, and they're covering all the outgoings.
Yeah, I understand. So yeah, what you're referring to is commercial properties generally will support themselves in the bank's eyes. Yeah. And they've got this product called a lease stock loan. Mm-hmm. So a lease stock loan is something where you may have no job, but you might have $1 million cash, or a tradie that just runs terrible financials and doesn't want to pay any tax, but he's got all this cash. Yeah. You can then take that and then buy a commercial property and get a loan off the back of a lease. Yep. Lease stock loans generally work with it's going to be a loan term based on the lease. Yep. Sometimes minus 1 year. So if you've got a 5-year lease, they'll give you a 4-year loan term. My first commercial property was done in this fashion. They gave me a 1-year loan term because the supermarket hadn't renewed at the time. Yeah. So it seemed risky, but the reality is, and the tenant didn't renew, and what actually happened is they just kept, the loan stayed. Like they don't call the loan in and...
Oh, they don't?
No, what's the benefit to the bank? They're just going to create fire sales and then they're going to lose out of their, because they want to lend. That's how they make money. So they might charge a penalty interest rate in between finance periods, but the reality is they will work with you, or other banks will, to get your business, and you just sort it out once that lease is fixed up. But you're looking generally at a 2 times interest rate cover to make it work.
What do you mean by that?
So if you're getting if you're paying $100,000 in interest per annum, you would want something that's giving you $200,000 in income. Okay. And that means if you can keep those ratios, you can so you'll need cash to make those returns work. But
would you call that a 2 times?
Yeah, 2 ICR they call it.
2 ICR. Okay, cool.
Sometimes it's 1.75, but yeah, I'll some very good brokers that will give you the current figures with that. But yeah, if you can cover your interest twofold, you can kind of lend forever in many cases. So an example of this is every single fund manager in Australia. They have, what's Stockland's got under management, tens of billions. There's no person guaranteeing these loans. The properties themselves are. The rents are guaranteeing these loans. So interest rate cover is how they do it. And these blokes, guys and girls, generally run at 50-55% debt levels initially, and then obviously that drops as you as the asset value grows and the rents. But that's how most of my kind of high net worth guys operate. Right. We personally run at about 30-40% debt. And
you mean yourself and Mina, your personal profit? Wow.
Yeah. So
Jesus.
And that means we're not we still look good in the bank's eyes. Yeah. Yeah. And most of because I got one of my clients, he's got 300 plus commercial properties. So some of my clients dwarf us.
Shit.
Or make us dwarf. And they've just held property for long periods of time. And the banks are desperate to get their business because, that you can quickly give them $20-30 million loans and it still looks good. Yeah. So, the income is very important, and it means you can have a self-sustaining portfolio. Mm-hmm. And that, in my opinion, is the biggest difference with commercial versus residential. You don't have a $20 million residential portfolio. No smart investor would have that, because what are you going to get, a 4% gross return? That's just inefficient. Yep. Even if that's enough money for you, you'd rather be getting a 6 or 7% net return with half the tenants and less responsibility, because the tenants do all the maintenance and stuff like that. So I'm a big believer, you start in residential, all the young guys and girls in this podcast listening, you don't just jump into this and expect to be a millionaire overnight. This is a get-rich-slow scheme. Start in residential, leverage up to your eyeballs if you can, cover it safely. Mm-hmm. That's what we did. And, that you might, let's say $1 million or million and a half of residential, maybe more, sit on that for a few years, let the market do its thing. And then when you get the equity from that, don't just keep following the old residential path, because you'll run into a cash flow hole. You won't retire doing that. So, but the equity you create, you put it into commercial, and all of a sudden you start supercharging your income, you're diversifying. It's a whole different ballgame. But yeah, you don't just start in commercial, I don't think.
Perfect. Well, it's exceptional advice, and I think that's how I was going to ask, because that's how you built your portfolio, is to work into resi first, more affordable, easier to get in, use that capital growth then, and you might be shipping it in a few different places, and then work into resi. Because if you're like you said, if I need to spend 120, 150 entry level, maybe I want to spend 200 grand to get into a good commercial property, it's going to take even saving 20 grand a year, it's going to take 10 years to get into that. It's a lot easier to have 3 or 4 properties, pull that equity out and be able to go in. Last little question I had just on the loans and stuff, why we're still talking about it. Is it still a 5-year sort of interest only loan, and are you switching to P&I after that, or for commercial is your strategy, or maybe what you're advising people is that they keep that on interest loan, they refinance? What's the strategy?
Always refinance, because you'd rather that cash sitting in an offset account anyway. So you're still going to be covering your you still got access to that money. Like paying principal is just going to pay the banks back, and unless you're done with investing and you don't want to do anything more ever again, just let it dribble into that. But otherwise, every 5 years, the way that banks operate in this country, they're pretty terrible what they do. They give better deals to new customers versus existing. So you're mad not to refinance every 3 years, in my opinion. Because you're just going to be, I was looking at some of our loans, and we're paying 7% on others, yet I'll go down the next door and I'll get it down at 6.1, massive differences with our debt levels. And you kind of just have to jump ship every few years or threaten to, and then you show them that deal, and then they quickly sharpen their pencil. But renegotiate a 5-year interest only at that time too, because again, you'd rather the cash in your bank accumulating. You don't have to spend it, but if a great deal pops up, you're not refinancing to get the money out and then buying. It's there, and then you just buy and loan on the new property.
Okay, so are you ever paying the principal off at the end?
Look, I'm in my mid-30s, so I've got no reason to pay it off just yet. But because someone asked me the other day, if you got given $100 million, what would you do? Would you just buy $100 million in commercial? No, I'd go to the bank, lend 50% and buy 200 million, just 2 shopping centers instead of 1. Diversify, or go one big industrial asset, or 5, and then, split in between retail and industrial. Debt, the reason the funds run at 50% debt, because it maximizes the return. So if you're a smart investor, you want to get good returns. That's the whole point of doing any of this, isn't it? Otherwise, just sit it in the bank and do nothing, So I will keep refinancing until it doesn't make sense. But as long as interest rates are lower than the yields we're paying, it makes perfect sense.
All right, I think we'll end on that note and that bit of advice for everyone out there listening. Scott, I appreciate you coming out, Rethink Investing. Thank you so much for jumping on the Everything Property podcast and sharing your knowledge with us. I have learnt a ton today about commercial property, and I'm hoping everyone that listening has done too. So really appreciate you coming out.
No worries at all. Thanks, mate.